In this video, we will look at fund that is run by Terry Smith. He's a British Warren Buffett style investor with great track record. We will look at what ratios he looks at when he finds businesses for investing. And then we're going to look at two main additions to his portfolio during the last 2 quarters. So let's get started. First of all, if you are not subscribed to the channel, you can do this by pressing the subscribe button under the video. It is absolutely free and you will not miss a single new video. Imagine that you can copy world-class athlete or a world-class programmer. In investing, you can do that. And today we're going to look at the portfolio and investment style of Terry Smith. He's a British Warren Buffett style investor. He's a famous author of the book Investing for Growth, which compiles his annual letter to shareholders for the last 10 years. His famous motto is find great companies, don't overpay, and do nothing. And today we're going to compare his performance to the S&P 500. Usually he compares his fund to the FTSE 100 or the MSCI World Index. FTSE 100 is a British index, but most of the companies have revenue from the United States and other countries. So for me, it was really interesting to measure his performance to the S&P 500. And on this table, we can see his fund's performance for the last 10 years. After subtracting all the fees, on average, it was around 19.5%. If we compare that to the S&P 500, the average performance was around 17%. So it's 2.5% higher than the S&P 500. If you think that is not a lot, let's use an example. If we invest $10,000 for 30 years for 10% annual growth rate, compounded annual growth rate, we will get around $170,000 in 30 years. But instead, if we use compounded annual growth rate of 12.5%, we will get 2 times more in 30 years. We will get $340,000 in 30 years. So we get 2 times more if we add only 2.5% of compounded annual growth rate. Most fund managers underperform the S&P 500, and Terry Smith was able to beat the S&P 500 for more than 10 years. So it is extremely interesting to see what kind of metrics, what kind of ratios when he chooses businesses to invest in. And on this table, you can see the main ratios Terry Smith uses when he analyzes companies. So this is from his annual letter to shareholders. The first ratio is return on capital employed. There are several ways to calculate it, and according to the book written by Terry Smith, he uses operating cash flow divided by equity plus net debt. So here is the formula. So if we return to his motto, find great companies, don't overpay and do nothing, find great companies is based on these ratios, and return on capital employed is the most important metrics of all. So this metric tells us what kind of capital is needed to get $1 in profits. Charlie Munger famously said that if we invest in business that has 6% return on capital employed, it is very likely that we get 6% compounded annual growth rate. So this ratio is extremely good predictor of the future price performance. As you can see from this table, his companies on average have much better return on capital employed than S&P 500 or the FTSE 100. Next comes the 3 profitability measures. The first one is the gross margin. It is the revenue minus cost of goods sold. As a result, you get the gross margin. Companies that have high gross margin will do much better in a high inflation environment than companies that have lower gross margins. I have made a separate video on this topic. I will link to it in the end. And again, companies that Terry Smith invests in has much higher gross margins than the S&P 500 or the FTSE 100. Then comes the operating profit margins. If we subtract sales, general and administrative expenses, we get the operating profit margins. Again, this margin is much higher than the S&P 500 or the FTSE 100. Cash conversion, how company can effectively convert its profit into cash. This is in line with the S&P 500. And lastly comes the interest cover times. What is the debt level of the company? Can it repay its interest expenses? According to Terry Smith, the most important measure is the first one. If we look at this table, we can see all industries by their return on invested capital. On the left, we can see the companies that have high return on invested capital, and on the right, we can see with low return on invested capital. And this ratio rarely changes over time. So the left side of the chart is the industries that Terry Smith invests in. So it's a very interesting topic on its own. Okay, if the first point was find great companies, the second point is do not overpay. And Terry Smith uses free cash flow yield as a valuation metric. He doesn't use price to earnings because price to earnings can be manipulated. So he uses free cash flow yield, which means that he takes free cash flow divided by market cap. And if we compare the average free cash flow yield for his companies to the S&P 500, we can see that he has a little bit lower free cash flow yield. So this means that his companies are a little bit more expensive than the average company on the S&P 500. But if we adjust for quality, for growth, they are not so expensive. So this is the main point. You get much more value for the high quality company over time than from the average company. As Warren Buffett famously said, it is better to pay average price for the great company than great price for the average company. Not only that, but his companies pay large dividend. He invests in blue chip type of companies that have predictable earnings. They are even called bond proxies. As a result, these type of companies are more protected during the crash. So they have more upside and more protected downside. Okay, now let's look at his portfolio. His portfolio is centered around 20 core positions. He has other positions, but they are around or less than 0.5%. So these 20 are his largest positions. And in the last 2 quarters, he had 3 significant additions: Microsoft, Google, and Amazon. According to his 13F filings, he has added Google and Microsoft in the 4th quarter of 2021, and he added Amazon in the 3rd quarter of 2021. Google, Microsoft, and Amazon have high return on invested capital, great profitability measures, and have low debt. And if we look at the free cash flow yield of Google, we can see that during the 4th quarter, it was on the high end. So knowing his investment style, we can see the logic behind his purchases. Also, I have made a video on Google. Here's the video. Here's the video about profit margins. If you are not subscribed to the channel, you can do this by pressing the subscribe button right here. Thank you very much for watching till the end, and see you in the next video.